welcome back. You're tuned into Power Breakfast on CNBC-TV18. Well, let's get a check on the Indian markets and how the trade setup is really looking. Mangalam joins in to get us all the market cues we need to watch out for trade today. Hi, Mangalam. Morning.
Good morning. So, last 2 days have been fairly good for our markets. We've seen the Nifty gain almost 5% while the Nifty Bank surge about 10% So, the last 2 days were also the last 2 days of the May series. So, in May series, we saw the Nifty fall about 3.8% and the Nifty Bank fall about 11% And had it not been for the last 2 days, these declines would have been much worse. So, what is it that could have propelled the last 2 days' moves? Well, the first one could be the fact that global markets were on a bit of a tear, so we got some tailwinds coming in from there. Secondly, Nifty Bank has been underperforming quite a bit, down around 16% before this up move came by. So maybe it could be on account of short covering. And finally, demand for Kotak QIP would suggest that maybe some of the relative stronger banks could get liquidity and flows coming in. And as a result of which, we saw the big move that we did in some of the names like ICICI Bank and Axis Bank. The other factor could also be lessening FII selling. So, day before yesterday, we saw the FII selling reduce, and yesterday the FIs bought about 2,000 crores in cash market. So that was a bit of a positive, and the domestic institutional investors too turned out to be buyers yesterday with a tune of close to around 150 odd crores. Then came the May series expiry. The rollovers have been higher than what we've seen in the last 3 series at 76%, but that doesn't count for much because the overall open interest on the Nifty is just shy of 1 crores, which is lower than the last 3-month average of over 1.1 crores. The SGX Nifty indicates a weak start, and that is something we will keep an eye out on given the global cues are rather weak on account of US-China trade tension. And Donald Trump also came out with a media signing an order on media executives for social media, and we'll watch out for his press conference on China as well and the Hong Kong issue. The Nifty is above the 20 and 50-day moving average. For Nifty Bank, the 50-day moving average would be a key level to watch out for. It comes in at around 19,528. We talk about the June series, a whole host of triggers out there. We'll keep an eye out on how lockdown issues come by, whether there are relaxations or not, and the remainder of the fourth quarter results.
Okay, Mangalam, thanks a lot for that. So that's what the trade setup would look like for trade today. But from markets, let's move across to macros. GDP data for the fourth quarter will be released later today. A CNBC-TV18 poll shows growth rate is likely to slow to just over 2%. The economy was under a lockdown only in the last week of March. Latha Venkatesh is here with the details. Latha.
It's an important set of numbers that will come because the Q4 GDP will give us some idea of the impact of COVID. Also, along with Q4, we get full year FY20 numbers. So to that extent, these are important numbers. What's the CNBC-TV18 poll saying? It's saying that the fourth quarter GDP will fall to 2.2%. The GVA, gross value added, is also an important number. It is minus taxes plus subsidies to GDP, and you will get the GVA. The GVA is expected to come at 2.4% compared to 4.5% in the third quarter and compared to 5.6% year ago. So 5.6 is also not very big in spite of a fairly small base. Remember, we were running at 7 and 8% in past years. The year ago is only 5.6, but even then, year on year, the GVA growth is only going to be 2.4. If you take the full FY20, economists told us that their expectation is that GDP will be 4.4% compared to 6.1% year ago, and compared to an average of 7 to 8% that we have been maintaining in past years. So FY20 GDP is likely to be lowest in about 20 years. Now, what is expected to go wrong? Obviously, because of the lockdown in the second half of March, the GDP will come down. The lockdown in March, 2 weeks of March, was particularly strict with no movement allowed, and usually that is the most hectic period of industrial activity because people want to finish a lot of things by March 31 to have a better number. So losing those 2 months was particularly severe, and some economists told us that 65% of the economic activity of the quarter happens in the last 2 weeks of March. Agriculture is expected to be the relieving factor, bringing in about a 4% growth because of a good Rabi harvest. Industrial output we already know was bad. If you remember, we got the March industrial output IIP, and that was minus 16.7. We also have core sector numbers, which showed us that steel and cement output were down by about 5%. Services were obviously hit in the second half of March because, no transport, no communication, no hotels. So a large part of services was affected. And therefore, economists told us that that part would have slowed to something like 2.9% compared to 5.9 or 6% in the previous quarter. This is how economists are expecting the GDP to pan out for the fourth quarter.
Okay, quarter four GDP seen at 2.2%, which is a sharp decline, of course, from last year. But let's move on to earnings then. Lupin reported a mixed quarter. Margins were weak, but both India and US growth was strong. Ekta is here with the earnings fine print. Hi, Ekta. Good morning.
Hi, Sonal. Morning. Well, yes, for Lupin, actually it was a mixed quarter because like you mentioned, the margins were weak. I'll start off with the revenue, which was down around 1.1%. The street was anticipating around a 13% decline, but the EBITDA declined around 32.6% with margins at 13.7% versus estimates of 14 to 15%. Now, the reason why, according to analysts, is that there was lack of cost control, which was visible in the quarter. Profit was aided by an exceptional inflow of around 83 odd crores. Maybe the only saving grace for Lupin would be the North America business, which was up around 14.7% on a Q-on-Q basis, and India, which was up 13.3% on a year-on-year basis. The conference call is this evening, so the street will want to know whether or not these numbers are sustainable or whether it's the impact of maybe one-time stocking which has taken place for Lupin this quarter, which many other companies have seen as well. So overall, I think the margin disappointment might weigh on the stock.
Oh, absolutely, Ekta. Thanks a lot for joining us. So, management commentary on the conference call, of course, something that we'll be watching out for. But other stock in focus is TVS Motor that has delivered its quarter four numbers, and it was a set better than expected. The revenues declined 20%, and the other details, Sonia is here with the earnings fine print. Hi, Sonia. Good morning.
Hi, good morning. Thanks for that. As you rightly pointed out, the numbers were slightly better than what the street was estimating. So I think that's something that the street will like. The revenues on expected lines fell about 20% because of the 30% fall in volumes. But what was good was that realizations were better than estimated. So realizations went up by 9.5% quarter on quarter. That's because of a higher three-wheeler share, the dollar appreciation and the price increases that the company undertook. There was a one-time loss of 32 crores that the company undertook because of COVID-related relief work, and that really hit their earnings this time. However, the company was quite cautious in its commentary. They did mention that it's only in the second half of the year, second half of the fiscal, when things will improve. The debt of the company has also gone up because of some capex that they had undertaken, and the stock is expensive at 35 times forward. So I expect the stock to be in the red today.
Okay, so TVS Motors in the red, but what about CEAT? Those numbers were good, Sonia.
They were. In fact, CEAT could be one of the stocks of the day on the upside because there was a big margin beat. Remember, the revenues have been under pressure for the entire industry because of lack of demand. Revenues were down 10%, but the margins went up 350 basis points year on year, coming in at 12.9%. It's the third consecutive quarter of CEAT reporting margins above 10%, and that's commendable in this challenging environment. Now, what was the reason for the margin surge? A better product mix, cost controls that the company has undertaken, and lower raw material costs. These three factors led to the margin performance being very strong. Also, gross margins for CEAT have expanded to 45.6% versus 39.3%. CEAT as well had to take an exceptional cost which hit their profits. There was a 29 crore exceptional cost that they had to take with regards to VRS for employees as well as COVID-related provisions. But I expect the stock to be in the green because the margins were a big beat in a challenging environment.
Okay, absolutely. Margin beat is something that the street would definitely like. But it's time to take a quick break. And as we take a break, here is some important opinion from the CEO of Bank of America on the US economy reopening and impact of the stimulus measures. Listen in.
This is a healthcare crisis. As you see, various adjustments by government authorities to the healthcare crisis and the human crisis, you're starting to see the economy come out of the hole. So if you think about the months during the year, that we started off strong this year with spending January of last year to January of this year up 10%, 9%, February was 10%. March was 7% as the impact of the virus came. April was 27 to 30% down. And what you're seeing in May is 5 to 10% down. And so you're seeing us come out of the, out of the depths of where we were in April, and that's good news. The real difference, though, is the amount of stimulus that's gone in to the economy is much different than in past crises. And so if you look at our customers' checking balances, say under $5,000 and under average balance that they're running before the crisis, they're actually up 30 or 40% in average balances in their accounts today versus 12, 13 weeks ago. That means that the stimulus is still in their accounts and is going to be spent, and part of it's been spent, but there's more to come, and we'll see if that stimulus can hold on long enough to the reemployment come back in and the confidence